Welcome back to the Canadian Income Tax Basics course. This is Module 2. In this module, we're going to take a look at the important tax terms and definitions you need to know to better understand and navigate the Canadian tax system. I'm going to break this module down into 5 lessons. The first lesson is the tax system. What are the important tax terms and definitions you need to know to better navigate and understand our tax system? The second is the types of income sources or income types you need to be aware of. Not everything is equal when it comes to income in the Canadian tax system. The third lesson is tax-related documents. What are some of the important documents you need to be aware of? What do they mean? And how do they impact your taxes? I'm going to show you what those tax documents look like and walk you through what they mean. The fourth lesson is payroll deductions. You might have noticed that every time you receive your paycheck, the number at the top is different from the number at the bottom, meaning what you make is not what goes into your bank account. There's something that gets lost in the middle, and I'm going to walk you through where that middle and what that middle means. Lesson 5 is calculating income taxes. What are the important tax terms and definitions you need to know in order to understand how income tax is calculated? Because the goal is that you want to pay your fair share of taxes. Claim what's right for you. You might have heard this term thrown around and you may not know what it means. The CRA. The CRA will come after you if you don't pay your taxes. You need to pay your taxes to the CRA. Have you received your benefits from the CRA? Well, the CRA stands for the Canada Revenue Agency. It's essentially the agency from the government that looks after all of the taxes across the country. Their goal is to make sure that every individual taxpayer is paying their fair share of taxes. They're receiving the right tax credits, the right benefits. Maybe you receive a monthly benefit or a quarterly benefit. It all comes from the CRA. Essentially, it's their job to make sure that the tax system is being run fairly, and if someone is not paying their fair share of taxes, or they have not paid their taxes that are overdue, they will impose interest and or penalties. So make sure you stay clear of the CRA, the Canada Revenue Agency, and follow tax laws accordingly. The other important definition you need to be aware of is called an audit. Essentially, what an audit is when the CRA, the Canada Revenue Agency, takes a look at your income tax records and they're examining your records to make sure, have you claimed the right amount of deductions? Have you overpaid your taxes? Have you underpaid your taxes? Are you claiming too many deductions that you may not be entitled to? Essentially, the part of the CRA's job is to audit your books and your records to make sure you are paying your fair share of taxes and you are fulfilling your tax obligation. And an audit can be triggered by a few factors. If you are claiming way too many deductions that you may not be entitled to, or you are under-recording your income. Essentially, if they notice discrepancies in your tax returns in terms of what they're expecting versus what you are putting on a tax return, that's a trigger. Or it could be through a random selection. And all this is called an audit. The NOA, or the Notice of Assessment. This is essentially a document that the CRA either sends you electronically or by mail after you file your tax return. And the NOA gives you a detailed summary of your income taxes, including a breakdown of how much money you have paid or how much money you have received. And it will show you whether you received a tax refund or if you owe taxes back to the CRA. Plus, it will show you, are you eligible for any tax benefits and or credits? What your RRSP contribution rule looks like. Is there anything that's left over on your tax return? I highly recommend reviewing the NOA after you file your taxes to make sure all the important information related to your tax account you are aware of. When it comes to the tax system, there are essentially 3 types of incomes you need to be aware of: gross income, earned income, and net income. Let's start off with gross income. What does that represent? Gross income is essentially your total income listed on your pay stub at the very top before any deductions are made. Gross income can include also other types of income sources such as sales commission, or maybe you're entitled to a year-end bonus. All that is included as part of gross income. Earned income is essentially what you earn from, let's say, babysitting. Maybe you have a summer job or regular paychecks from a full-time job. While all income from pretty much providing a service or selling a product is considered earned income, it's only taxable once you make more than a certain amount, which is known as the personal basic amount. And for 2023, that amount is $15,000. The next one is net income. And this is a very important number you need to understand. I like to think of net income as a fishing net. Essentially, this is the money you bring home after all those deductions and credits have swam away. This is also referred to as your take-home pay, which is essentially the money that's deposited into your bank account from your pay stub. Net income is also used by the CRA to determine any tax credits and any benefits you may be entitled to on your tax return. If I want to summarize this very quickly, gross income is the very top line on your pay stub. Everything you earn is called gross income. And earned income is essentially income you make that is more than $15,000 after the basic personal amount. And net income is essentially you take your gross income less CPP deductions, less EI deductions. Maybe you have benefits from your workplace. Essentially, all those benefits and credits are deducted from your pay stub, and I'm going to show you what that looks like later on. That is net income, and that's what goes into your bank account, and that's what's used to determine any additional tax credits, benefits you may be entitled to after you file your taxes. The first one I want to talk about is called a T-slip, and you may receive various T-slips when it's around February, March of each year, just before you have to file your taxes. A T-slip is essentially a document that tells you how much money you've earned and how much taxes was taken away from that money. And there are different types of T-slips. For example, if you are working a full-time job, you're going to receive something called a T4. If you got a scholarship from your college or university, you're going to receive something called a T4A slip. And if you're a student, you're going to school and you're paying tuition for your school, whether it's full-time, part-time enrollment, you're going to receive something called a T2202 slip that shows you how many semesters or months you were in a semester and how much you paid for your tuition. The next one is a TD1 form. A TD1 form is essentially when you start a new job in Canada, you have to fill out something called a TD1 form before you start work. And this tells your employer how much money you should get on your paycheck after taxes. So it's very important you fill this form out correctly because it's going to impact your net income that we talked about in the last lesson. The TD1 form includes information about any tax credits you may be eligible for. Your employer uses the information on the TD1 form to figure out how much tax to take off your paycheck. And this is a super important term that you should be aware of. It is your pay stub. It's important to understand how to read your pay stub because at the end of the day, you are working for dollars. Those dollars go into your bank account so you can spend on things like rent payments, mortgage payments, your car, groceries, etc. So it's very important to understand how the pay stub works. Your employer gives you a pay stub every time you get paid. This could be bi-weekly, weekly, depending on how frequent your employer pays you. The pay stub is essentially a record of your earnings. It shows how wages were calculated, including the pay period, your pay rate, essentially how much do you get paid per hour. It'll show you the number of hours you work and any other deductions that are taken off your pay stub, meaning the difference between how much you've earned and the net income. The way to think about it is a pay stub is essentially like a report card for your earnings. It helps you understand exactly how much you made and where it all went before the money hits your bank account. And it's very important you check your pay stub every time you get paid to make sure everything is correct. If something is not correct, reach out to your employer. Let's take a look at what one of these tax forms looks like. The first one is a T4 slip. As you can see at the very top left-hand corner, it will show your employer's name. It will show you at the top as well what year this tax slip is for. Box 14 will show you employment income, and any taxes deducted is box 22. This will essentially summarize all your pay stubs throughout the year. This document is what gets used to put on your tax return. The next slip we're going to take a look at is a T4A slip. This will show you what university or college you went to. It will show you what year it relates to, and it will show you essentially how much you received in scholarships or any grants you may have received. This is an example of a T2202 slip. It will show you the name of the college or university, what program you're in, your student name, your student address, how much did you pay, were you a full-time student, a part-time student. This is what's used to determine the tax credit that you can receive on your tax return when you file as part of the tuition tax credit. And this is what a TD1 form looks like. This is what you need to fill out before you start work to make sure that your employer is taking off the right deductions on your pay stub. And this is what essentially a sample pay stub looks like. It will show you the company's name, where you work. It will have your employee ID, your name, the pay date, the amount of money that goes into your bank account, which is called the net pay. As you can see at the very bottom of the slip, this is how much you've earned year to date, how much deductions were taken off year to date, and your year to date net pay. It will also show you what deductions were taken off your pay stub. So for example, in this case, you may have earned $1,600 plus $125 at the gross income level, but from that, TPP is deducted, EI is deducted, income tax, if you have union dues, and a whole host of other deductions, and that's the difference between your gross income, $1,725, deductions that get taken off, $430, and the net pay is what goes into your bank account. As we saw in the last lesson, the difference between gross income and net home are all the deductions that's taken off your pay stub. Some of which we looked at were EI, CPP, and taxes, so I'm going to break that down in this lesson. EI stands for employment insurance, and this is like a safety net for employed individuals. If you lose your job and can't find a new one right away, EI is there to help you out. It gives you some money for a while to pay for things you need like food and rent until you essentially find a new job. EI can also help you if you are sick and can't work. EI is also a factor when you want to take maternity leave and if you are pregnant and want to stay home with your baby, so EI will give you money while you take care of that. EI can also help you if you need to take care of a sick family member. Employment insurance, or EI, every time it comes off your paycheck, the reason it's done is so when you need help, when you can't work, EI is there. It's a way for the Canadian government to help people out who can't work or can't find work for certain reasons. CPP, or the Canada Pension Plan. This is a monthly payment like an allowance to replace part of your income you used to make while working. CPP is the amount you receive when you're retired, and you can claim CPP as early as 60. You can take it at 65, 70, anytime between 60 and 70. The amount you receive as part of your CPP allowance is based on how much you've earned during your working years, and essentially how much you've contributed from your working years to the CPP plan. The CPP is essentially an allowance from the government to replace your working income when you're retired, so you can pay for things like food, shelter, rent, etc. In Canada, as we discussed in the last module, there are both federal taxes and provincial taxes. And essentially they're collected from your taxable income, which is your gross income minus deductions, minus tax credits, and any other adjustments. The federal tax is collected by the federal government, and it is used to fund activities and services that benefit the entire country, like roadways, like hospitals. Every time you go to the ER, you go to the doctors, all those services are funded by taxpayer dollars. Provincial tax, on the other hand, is collected by the provincial government. It's used to fund activities that primarily benefit the residents of that specific province. When it comes to calculating income taxes, one of the deductions you can take is claiming dependents. What that means is that if you have a family member who lives with you, who relies on you for financial support, you may be able to claim them as a dependent on your tax return. You'll receive a tax credit for that individual. This can allow you to claim various expenses, credits, amounts that can help lower your tax bill. Some of the deductions you can claim on your tax return for a dependent include the Canada Caregiver amount, the disability amount, or the eligible dependent credit for your dependent. And there are other tax deductions and credits you can also claim outside of dependents. For example, you can reduce your income tax by claiming eligible tax donations and credits. Essentially, tax credits and deductions are specific categories of spending that the government recognizes and rewards. They want you to help charities in need, so you can deduct that money off your income tax and get a benefit and help a charity out. It's a win-win. For example, you can also deduct childcare expenses if you paid someone to look after your child while you worked or studied. It's very important to understand all the tax credits and deductions that are available to you to make sure you are lowering your tax bill to pay your fair share of taxes. Tax-free income. Yes, there are ways to earn tax-free income in Canada. You can earn income from sources that are non-taxable, and they do not need to be reported on your tax return. For example, lottery winnings, gifts, inheritance, Canada Child Benefit payments, life insurance proceeds, and income from your tax-free savings account, you will not be taxed on these dollars. You don't need to report them. It's all good. And the best part is that these sources can help you increase your wealth without having to increase your tax burden. So take advantage of all the tax-free income sources so you can increase your income without increasing your tax burden.